Hey, folks, welcome to another edition of Money Across America. My name is Garry Thurman, your host. And as I say every single week, I'm so honored to be able to go out here across this beautiful country of ours and interview what I feel are the top financial planning firms all across this great country. And, with saying that, we cannot forget the great state of Texas, right? Now, my buddy Ryan has several locations, which we're going to get into in a few minutes, but home base is in Texas, which we all love, which is probably extremely hot right now already. But hey, Ryan, how you doing, buddy? Welcome to the show.
I'm good, brother. Thank you so much for having me on today. Looking forward to adding some value to the audience here for sure.
We're going to have a lot of fun. Now, Ryan, you and I think a lot alike. You and I talk a lot, and just like with all the other people I've already interviewed, what I'm trying to do with this podcast and this video series is really educate people across America how the right type financial planners are all working the same way. We have the same goals. We're not just trying to catch growth. We're actually doing planning for folks. So that's what I kind of want to break down and dissect on how you're doing things there in Texas and Oklahoma and Arkansas and New Mexico and all these great locations that you have. And I like jumping into this, Ryan, right off the bat. What kind of trends are you seeing, or what kind of trends are you talking to your clients about right now in 2025?
I think the biggest conversation we're having is, Donald Trump's going to serve a second term, and the Trump tax cuts under the Tax Cuts and Jobs Act were scheduled to expire and sunset in 2025. Well, obviously, we know with the big, beautiful bill, it's big, it's beautiful, it's perfect, right? By Trump impersonation, but there's some scuttlebutt going between the House and the Senate right now about what it actually winds up being, right? Because it is going to get through at some point in time. But I do believe that the tax brackets under the Tax Cuts and Jobs Act will stay. And what that represents to folks is an incredible opportunity to save money on taxes, because you might think that these tax cuts and these tax brackets and these tax deductions and over 65 exemptions will be here forever. But guess what? They won't. All right. And the reason why I say that, Garry, is that, we're $37 trillion in debt and climbing as a nation. The country gets its money to pay its bills from tax revenue. All right. We're in one of the most favorable tax environments that we've ever been in. Okay. The challenge with that is if taxes are low and debt is high, and then let's add the interest on the national debt on top of that, it creates a situation where it's not sustainable. Right. So the biggest risk people have is legislative risk. And it's a risk that's often overlooked by financial planners, because if you retire today and live 30, 35 years in retirement, you're going to spend a long time in retirement, hopefully enjoy a great life, right? But you're going to go through election cycles, and you can go through as many as 18 to 24 of those cycles in a 30-year period. Right. And that's important because, new people come into office, and what that means is everything in Washington, D.C. is subject to change. That includes these tax rates that we're going to be in for a while. Right. And then there's, we can also spend a minute to talk about this. We'd be remiss if we didn't. There's also the tariffs, right? So, there's this conversation about abolishing the IRS. It's not going to happen, folks. I got news for you. But then there's also, hey, let's start charging these countries to do business in the United States and reduce tax revenue and offset that reduced tax revenue with tariff revenue. Well, let's look at this. So in 2023, the U.S. took in $2.2 trillion of tax revenue. All right. And that was what we took in. Okay. And the same year, we took in $80 million of tariff revenue. All right. Let's round it up to make it easy. Let's say it's $100 million. Okay. So we took in $2.2 trillion of tax revenue. We took in $100 million of tariff revenue. Okay. That means we've got a deficit of $2.1 billion we've got to fulfill to abolish the IRS or make a major dent and decrease tax revenue for the country to operate and pay its bills. Well, let's go back and look at what the imports were in 2023. It was $3 trillion. Okay. So what that means is to eliminate taxes and have tariff revenue pay for the government's expenditures, that $3 trillion in imports would have to be taxed, or the tariffs would have to be 70% to equal $2.1 trillion in missed revenue, right? So can you think of the typical middle America family going to Walmart and paying 70 cents on the dollar more for the goods and services they buy at Walmart? And the dog just doesn't hunt. So, ultimately, I think with where we get to with this is we've got a great opportunity right now to convert money from IRA money over to Roth IRA money. You pay taxes when they're on sale. They're on sale today. All right. And I think that, we will have a period of time where these tax cuts and these tax brackets that are very favorable for Roth IRA conversion stick around. But beyond that, I think we see a major increase in taxes.
Oh, absolutely. I mean, and you threw out the 36, $37 trillion we're in debt. And I think you and I both know it's more than that. Every dollar that comes in on taxes, I mean, it's just going to continue to grow because we're paying for Medicare, Medicaid, Social Security. We're paying for that interest on the debt. A lot of our dollar in debt goes to all those four things. So I'm with you. I do think taxes are on sale. I use a phrase saying, do you want to pay taxes on the seeds or the harvest? That's exactly where we're at. And I think that's one of the things we're seeing since post-election is that now we're looking at having lower taxes for the next few years. Why would you not, or let me ask you this, why would anybody sitting down in front of you or anybody on your team be hesitant on actually starting to convert over to Roth? They're just a little bit nervous about paying that tax, right?
Well, some people are, but I think some people don't necessarily understand the long-term implications and impact of not converting to Roth. All right, let's talk about that for a minute, because we had the Secure Act, right? And that was setting Americans up for retirement. I can't remember the acronym, something like that. It was not setting anyone up for retirement. It was setting up people for taxation. Let's be very clear about what was happening there.
That is.
Okay.
Yep.
And so let's just go through a couple of examples. The first and the biggest one to me is that when, we're going to have a major shift in wealth in this country starting now until the next 20, 30 years. All right. And that is going to be that females are going to be the controllers of the majority of the wealth in this country. And the reason why is females outlive males, okay, statistically. And the females are going to inherit whatever the males have done, right? Usually a husband in a lot of cases, not all cases, but many cases. The husband's kind of the head of the financial household, right? Takes care of the money, that sort of thing. But that money's going to transition from the husband over to the wife, okay? In that case, the females are going to control the largest population of dollars in U.S. history starting now going into the future. Well, that's interesting because what also happens is when one spouse dies, the surviving spouse has 1 year left to file a joint tax return, after which they move over to the single filer brackets, which are nearly double the tax rates on the same amount of income. Now, what typically happens is a Social Security check is lost, right? Because only one Social Security check comes in after one spouse dies, the larger of two, by the way. And then the taxes go up. So the surviving spouse has less income, pays more taxes, all right? And then they're also subject to RMDs, required mandatory distributions, which, this may happen at age 80, and those RMDs start getting very, very large at 80, 81, 82, 83, 84. So the taxes that the surviving spouse will pay can get really large, which is a great case for doing Roth IRA conversions, okay? That's one. The second one that's mind-boggling to me, and it's actually got me thinking about this with my own parents, by the way. My dad's an airline pilot with United Airlines. He's actually about to retire. He's done well. And I'm going to it. I'm saying, Dad, listen, when you retire, you got X and you can't spend Y because you're just a thrifty dude. You always have been, right?
Yeah.
So, there's a chance that I'm going to inherit a large amount of your money, with the majority of which is inside of a 401k. All right. So I want you to do Roth IRA conversions.
Right.
Okay. And the reason why I want you to do them is when I inherit that money, I've got 10 years to liquidate an IRA or a 401k account. All right. Well, I've done reasonably well in life. So now all of a sudden my dad is throwing, when he dies, he's throwing his money on top of my income, right? For that, because I've got to liquidate that IRA over 10 years. And what happens is a lot of my dad's money, mom's money, by the way, goes to the IRS. And I know my dad well enough to know he's a patriot, flew F-14s in the Navy, whole 9 yards, Top Gun graduate. But he is not going to be someone that is going to want more than his fair share of money going to the government, whether he's dead or alive. All right. Here's what's happening. I'm actually offering to pay the taxes, Gary. the Roth IRA conversions. Okay. Because I know if I can get him to convert now and we can pay those taxes now, and that money's over a Roth IRA, when he passes on, I get to inherit that money tax free.
That's great.
And so, the whole, there's a lot of strategies that are coming about because of all these interesting opportunities that present themselves. You just got to know where to look. And more importantly, you got to work with the right advisor.
That's right. That's right. We're going to get into that deep. So you mentioned a word that I kind of want to dive into because I kind of want to get into some income planning and how you do some income planning. But I want to start with something a lot of advisors, I think, just overlook. They don't talk about it, or they don't help their clients strategize with it. And that's, when do you turn on your Social Security benefits? What are your thought process behind that, Ryan?
Man, there's so many factors that go into it. And what the first thing I want people to do is I want you to view Social Security as an asset. All right. So I keep a calculator handy. Okay. Let's say that your Social Security check is $40,000 a year. All right. And let's say you live for 30 years in retirement. Well, that's $1.2 million of money. Gary, if you had $1.2 million in a bank account somewhere or an investment account, wouldn't you safeguard it? Wouldn't you be smart with it? What do you do? Be a good steward of your dollars, right? And the answer is yes. Social Security is no different, okay? More importantly, Social Security is also very tax efficient because only 85% of Social Security is taxable, right? So it's actually more tax efficient, in a lot of ways stronger than a pension, okay? But when do you take it? Well, it depends. If you retire early, say at 55, you may consider taking Social Security at 62 because your portfolio has to produce income for a longer period of time than waiting until, say, 62, 65, 67, whatever, later in life to retire. That's one example. Another one is if I have a married couple and they're retiring at, say, 64, and the wife has a spousal benefit, I would tell the wife to take her benefit as soon as she can. And then once the husband gets to 70, he turns on his benefit.
Right.
And the wife gets a top up of the spousal benefit from the husband, right? That's another way to maximize Social Security. But what if we're doing a Roth IRA conversion strategy? Okay. If we're going to do Roth IRA conversions from, say, 59.5 up until age 70, I wouldn't recommend either one of them take Social Security until age 70 because all they're going to do is kick up the taxation on Social Security.
That's right.
It really just depends. And then lastly, look at your income gap. What do you have coming in from Social Security, pensions, rental income, or any other guaranteed source that you might have? Okay. And then what's your income need in retirement? And what's the difference between what those guaranteed sources make up and what you actually need to have coming in, and kind of figure out where you are with income gap and determine the best time to take Social Security from there.
Yeah.
But it's interesting too, that if we look at Monte Carlo scenarios, oftentimes the probability of success will change very little based on when you take Social Security income. It's mind boggling, all right? But what changes dramatically is the taxation. That's a big thing. And so Social Security is not about what you see on that statement. It's about how much money you keep in your bank account after you pay for taxes.
I love that. I think everybody's different when it comes to Social Security. Every couple, every individual, and you have to look at so many different things. What is it? 576 ways to file Social Security, and there's 2,000 plus rules to those 576 ways to file. So I think my point, and I want everybody across this country to hear, is sit down with a fiduciary advisor. Don't just turn your Social Security on because your uncle did it or your coworker did it. Sit down with someone like Ryan or myself. Make sure you optimize that Social Security benefit because it can be a great, great benefit for you and your spouse throughout retirement. And you talked about income gaps, Ryan, and this is a big thing for me. And we're going to talk about the A word for a few minutes. We're going to talk about annuities. Here at Guardian, we'll use a properly structured income annuity to fill that gap. So maybe people can delay Social Security, or they can delay taking money out of their IRAs, whatever the case may be. What are your feelings and how are you looking at the annuity world when it comes to your clients there in Texas?
To me, Gary, here's the big thing. It doesn't matter if it's an annuity, a stock, a bond, a mutual fund, a real estate investment trust, a real piece of property that pays income, structured notes, structured products.
Right.
I think I pretty much named them all, right?
Yeah, you did. Yeah, you did good.
And so none of that matters what they are. And here's why I say that. They're only tools. So if Callie, my beautiful wife, asked me to hang a picture in the hallway, all right, I'm going to go out to the toolbox and I'm likely going to grab a level, a tape measure, because God forbid if that picture's crooked or not where she wants it. I'm going to hear about that for a long time, right? And then I'm going to grab probably a wall anchor and a screw, all right, and probably a screw gun. That's what I'm going to grab, okay? And I'm going to go up there and do the job of hanging the picture and get a vacuum and clean up. So clean up after I make the mess and all that kind of stuff. And I'm going to go back downstairs and I'm going to put those tools back away in my toolbox, all right? Well, in that instance, when I went to the toolbox to select the proper tools for hanging that picture, I didn't pick the socket wrenches. I didn't pick the crescent wrenches. I didn't pick the ratchet wrenches or the Allen wrenches or whatever other cool tool you got in your box. And I know guys out there get all kind of cool stuff in the toolbox, right? Especially out of Stapo guy, right? But the bottom line is, in that moment, when I bypassed the wrench, bypassed the socket set, bypassed the hammer, right, and the screwdrivers, did that make them a bad tool?
No.
No, it just simply means that those were not the right tools for this particular job.
That's right.
So I think people need to get away from, there's the Ken Fisher's an annuity hater, Eric Ramsey's an annuity hater. It doesn't matter if it's an annuity, a stock, a bond, or a mutual fund. It only matters what it does, right? And if you look at the ways to get guaranteed income, there's two ways you can do it, all right? You can go out today and buy a 30-year treasury bond. So somebody who's 65, if they buy a 30-year treasury bond, they live to 95. Let's say they put $1 million in that. Well, 30-year treasury bonds put kicking up around 4.7, 4.8%, I believe. So you put $1 million in and you get $48,000 year income for the next 30 years. At the end of that 30-year period, you get the $1 million back. Right. Pretty cool, okay? And then at 95, you could spend $100,000 a year of that million without investing anything, and that'd make you to 105 years of age.
Yeah.
Right? So you're probably going to be okay doing that. Cool. The other aspect is you go look at the annuity world. All right. And so in an annuity right now, you could probably put closer to $500,000 or $600,000 into an annuity, and you would get that guaranteed income of $48,000 a year, probably more than that for life. Yeah. But you used 40% less capital to do it. Then you take that 40% remaining capital and you can invest that in other ways so that it likely grows beyond that $1 million value you'd have when that bond matures in 30 years. You get that $1 million back. You're probably closer to, $1.6 million. Right? So you've got to look at the big picture, look at the various options. And you also have to look at the risk. Gary, there's income personalities, okay? And there's a risk-on personality and a risk-off personality.
Right.
The risk-on personality is someone who says, listen, Ryan, I've got $4 million. My income need is $80,000 a year. The 4% rule says I can got $160,000 out of my portfolio, grown for inflation, and I'm going to be fine. All right. Now, if that's you, that's awesome. Okay. Because what that basically means is you could lose 50% of your portfolio value and still have the income you need coming into the household. All right. And if you lose 50% of your portfolio value and you stay the course, you're likely going to recover over time. Right. Okay. Now, is that going to be comfortable? No, it's not. You're not going to like it. Is your spouse going to like it? No, she is not going to like it in any capacity. Okay. But if you're going to go down that road, that risk-on approach, you've got to be willing to stick with it for the long period of time.
That's right.
The other side of that is the risk-off approach. And the risk-off approach is someone who says, listen, Ryan, I want to know this. I need $80,000 a year in income to take care of my food, water, shelter, clothing, access to healthcare, medicine, a few vacations per year, and transportation. And if I have those things coming in, I'm doing exactly what I wanted to do in my golden years. Perfect. Okay. Let's go out and find some guarantees because this person wants guarantees. And what it comes down to is which one do you want to go with? Do you want to use the 30-year treasury bond route? Do you want to buy an annuity? And when it comes to buying an annuity, there's all kinds of marketing out there. 25% bonus, 10% roll-up rate, this, that, and the other. Folks, listen. All of that is marketing jumbo mumbo from a Kabuki Theater, from his insurance companies trying to capture your dollars. Right. Here's what Gary and I do well. We're fiduciaries. We go out into the world and we find in your unique situation the carrier that has the strongest ratings, okay, that also provides the highest amount of income for every dollar you invest. Doesn't matter. And nothing else matters from that point forward.
I love that. You just made me think of a conversation I just had yesterday with a client who threw up or brought up the 4% rule to me as well. And we're having a conversation. I said, so why do you only want to make 4% when I can show you how to make 7% guaranteed? And that kind of got his attention a little bit. And then another thing I pointed out, with some of these annuities that we're writing, Ryan, it could be my 401k, but I can turn an income on that's going to last for the rest of my life and Rhonda's life. That's fascinating that we can do that with qualified money. And then now we have wellness riders added. So if we get sick, we can double that income for a certain amount of time. I just think the annuity world has gotten a lot better. And I think Americans are not so educated on how they're different now, because the annuities back in the day, they wasn't that great.
Well,
but the annuities now, they're wonderful. And you and I being independent advisors, we can go out and find those companies that have the best solution for the clients, right?
Well, for sure. And to that end, some of these riders, they call them, right? A lot of people don't want to buy long-term care insurance. Well, guess what? If you buy the right annuity, you can actually get long-term care coverage without paying long-term care premiums.
Great.
But you gotta get educated about what's out there. All right.
Right.
And then the other thing too, Gary, is you and I talk about all the time. I think it's less than 11% of companies in America offer pensions anymore. Okay.
Right.
So when I have clients that have pensions, they actually get them because we work with several major oil companies here in Houston, and plenty of them still produce pensions. Some of them actually make you take the pension in a payout and don't all get a lump sum.
Right.
And so for those people, especially, I got a guy, I'll say his first name. His name's Herm. He's a great human being. All right. He has never touched a dollar of any of his other savings because he lives off that pension.
What?
And his biggest complaint, by the way, is, Ryan, I wish the pension was bigger. Right.
Really?
Yeah, he really does. And so the bottom line here is this. You don't have to work for a company today that provides a pension, right? It doesn't matter that only 11% of companies provide pensions today. You know why, Gary? Because every single person listening to this podcast right now has their own ability to go out and create their very own personal pension plan. And you're going to use an income annuity to do that.
That's right. I love it. So two things. One thing you brought up there that I want to hit on for a few minutes. We talk about all the time, the number one fear in America is, people running out of money. I think longevity risk is the greatest risk there is, because it brings all the other risks to the forefront big time. And one of those risks we're seeing, Ryan, is that people are living longer, which gives them more opportunity to get sick. Yet people are not thinking about that healthcare component, about what would happen to their spouse, their children, their family. God forbid, if they're one of the 70% of people who get some or need some type of long-term care, that has to be a hot topic in your office as well.
Well, certainly it is. And there's several ways to skin that cat. All right. I'm sorry if you're a cat lover, by the way. So, the healthcare issue is a big deal, because when I started in this industry, it was a 1 in 2 chance, which means a 50% chance of someone in the household needing long-term care coverage or having a long-term care crisis. Now it's moved to 70%. I started this business in I think got in the industry in 2006. All right. So what is that? 19 years now? Is that right?
Yeah.
20 years. Oh gosh, dang, almost 20 years.
Wow. Life's 20. Yeah.
Right. Going on 20 years. So in 20 years, that number's moved from 50% to 70%. And that means that one of you is going to need the care. It's going to happen. Okay. And so you need to be prepared for it in a big way. And the way you do that is you have income coming into the household. Okay. That income needs to come in and be sustainable for the long term. There needs to be some type of a hedge that allows that income to double in the event you need long-term care. All right. Now, there's people out there, Gary, that can also afford to self-insure.
Right.
And don't think about this for a minute. So, right now, I think the average cost of care around the country, or at least instead of Texas, is around $85,000 a year.
Right.
Now, for inflation purposes, we're doing financial planning. Long-term care costs, we actually grow for 5% a year, inflation. Okay. So if you look at those numbers, $85,000 grown for 5% inflation over a 25-year period gets to be a big number. Okay. Multiply that big number times 3. If your surviving spouse, if you have enough money to where your surviving spouse could live the same lifestyle I'm saying she, by the way, lived before you went into the home and passed away, then you can afford to self-insure.
Yeah.
All right. Because if you can do that, that's awesome. Okay. You don't need it. The other thing you can look at is the home. These homes people have, oftentimes are paid for. Homes are a great hedge against long-term care. All right. Because the home could be sold. All right. If it's paid for, say the $300,000 home today is worth $300,000. Maybe it's worth $500,000, $600,000, $700,000 when the long-term care need arises. That home can be sold and the cost of care can be covered. You could also consider a reverse mortgage. I'm not a huge fan of that, but if that's the solution, that's the solution. Okay. And then lastly, look at the overall planning part of your plan and make sure in some aspect of that you've got some coverage happening. And it's like an aviation, Gary. We say if you plan for it, it usually doesn't happen. And if it does happen, you're well prepared for it.
I love that. I think it's a big, I got a brand new book coming out, Ryan, and it's all about your health and your wealth. And what really got me on this journey was, why are you so worried about your wealth if you don't have your health? You're not going to be able to enjoy it. So I think,
look at Steve Jobs.
Prepared. Go ahead.
Look at Steve Jobs.
Yeah, there you go.
I mean,
perfect example.
Arguably the wealthiest man, or certainly one of the top 10 wealthiest men in the country. When he passed away, got cancer, lost that battle, unfortunately, and it was hard fought and sad to see it go. Sad to see it happen to a great man like that. But I mean, that's a perfect example. And the other thing too is that we sit here and talk about money, and I got news for you, folks. Your most valuable asset, your most valuable commodity that you have in your golden years is not your money. It's your time.
That's right.
It's your time, right? If you're getting to age 60, 65, 70, you're running out of time.
Yeah.
And now it's time to start living. Okay. Your money is nothing more than a tool that allows you that helps you enjoy the time you have left.
Yeah.
Right. There's one last aspect of that is you got to be healthy to enjoy the time you have left.
That's right. You want to have fun in those go-go years, especially, right, Ryan? Right when you first retire, you're healthier mentally, physically. You want to have fun. Then you're going to slow down a little bit. But that's where it all comes down to planning and working with the right type of advisor. Don't just work with an advisor talk about growth. Actually work with someone that puts a plan together so that you can sustain that retirement and take care of your family when the good Lord takes you home. I love that.
Well, Gary, this is important, okay? If you go out to the big box retail firms out there, and a lot of us are comfortable going there because they've been here. I've seen Raymond James for 25, 30 years. I've seen Edward Jones. My 401k plan's been at, a Voya. I'm comfortable with these big names, all right? What a lot of people don't realize is that these big names are publicly traded companies. And they have boards, they have shareholders, and in order for their stock prices to grow, they have to have good earnings, okay? And so what happens here is they're growth-oriented companies. They want your money to grow. And they want it to grow because as your money grows, they make more and more fees. Their money grows, their earnings per share grows and goes up. That's good for them, okay? So that's why they're so growth-oriented. We call them growth and accumulation specialists. Well, a good growth and accumulation specialist can get you to the top of the retirement mountain, as we say, all right? But once you get to the top of that mountain, you have to get safely down the other side. And if you do the same stuff that got you to the top of the mountain, going down the mountain, you're likely not going to make it down. And so that's just a big thing. So Gary and I specialize in retirement. It's what we do. All right. So at Allied Wealth, my firm, and my Redefined Retirement podcast, we have a saying. It's personal finance to retirement. And that's what we do well. And so if you're out there thinking about, these other big box firms, you're comfortable with them, Gary and I have the same stuff. We have the firepower of Charles Schwab and Fidelity behind us. Okay. Right. Not to mention an entire team of certified financial planners that do plans for us and the whole 9 yards to help you navigate what's going to be your golden years.
Yeah. And another thing that makes us different, Ryan, in my personal opinion, we have teams. We have teams of people, teams of experts around us to really help these clients build that plan. And I just think you're not just working with one person. You're working with a team of professionals, and that's what we pride ourselves on here at Guardian. Here's a tough question, and it's one I always like to ask. What is something you wish every American understood about financial planning?
But man, there's so many ways to answer that question.
I know.
I'm going to go, let's start with the younger years. All right. Okay. The younger years is pay yourself first. Yeah. All right. That is just such an important thing. And paying yourself first means that, the check comes into the household, and then they pay their cell phone bill, the car note, the car insurance, go out to dinner and, have a couple of nights out, that sort of thing in the weekend, groceries, rent, whatever. All right. And then they try to save what's left. And guess what? There's nothing left.
Yeah.
All right. So the first thing that you do is allocate your check, have 10%, 20%, whatever it is, take it out of your paycheck and live on the rest. And yes, you might have to cut back in some areas, but it will sort itself out. Now, what's awesome is as you watch those savings grow as a younger person, I remember the first time I saw like some money actually accumulated in my account, and I could breathe a little bit, and it was really cool. And then that money started making money for me on top of that. So pay yourself first. This is a hard one for me, man. If you're in your 50s, my mom and dad went to college, and that was back in the years when you come out of college, the $80,000 a year paycheck was waiting for you, right? And you had an edge above people that didn't go to college. Sadly, I think that edge is slowly diminishing, all right? And I'm seeing a lot of folks that are putting their kids through college because they value doing that, right? And the kids are coming out of college and working at Starbucks, all right?
Yeah.
Be careful, because a lot of the folks that we serve, they're putting kids through school at around age 50, okay? And so they're sacrificing saving for retirement while they're putting kids through school, and the kid comes out of college going to work at Starbucks. So just be careful with that stuff, all right? The last thing I'll say is this. The numbers get pretty staggering. The sooner you start saving, the less you have to save per month to get you where you want to go. Right. And I've got a table in my office, and I can't remember the exact number, but if you wait until 50 to start saving, you try to get to $2 million by the time you're 65, the numbers, it's so big that a lot of people see it and it's uncomfortable. So the sooner you start saving, the better off you are.
I love that. That's something else we do here is we love working with our young people and just educating them, right? They may not be our clients yet, but we're educating them on those steps to take. And I always say what you said, pay yourself first. You got to do that. What's your personal why? You get up every day. You got all these locations, 22 different offices now, which I think is incredible. What is your why? What pushes you to get up every day and just keep pushing and keep helping these folks in your area?
Man, we have a saying at my company, Allied Wealth. It's PPG, all right, and it stands for personal, professional, and financial. PPFG stands for personal, professional, financial growth.
Okay.
And so I used to focus on my personal, professional, and financial growth. All right. And the moment I stopped focusing on mine and I started focusing on others, I became wealthy. And it's mind-boggling. The value of my company went up, my personal savings went up, and it's just awesome. So in that became a love and a passion for helping people succeed. And I can tell you client story after client story. For example, when I got into this industry in 2008, all I sold was fixed products and I was basically a product salesman at that point in time, early in my career, and not the advisor I am today. But I had a guy come to me in 2008. He actually came to me in 2007. 2008 happened, 2009 happened, and that guy didn't lose one dime of money, not one dime. Okay. And he still comes to this office. I mean, we're still client and advisor. He was just here last week, as a matter of fact. And he thanks me to this day every time he sees me. Every time he sees me, right? And so it just would have been disastrous and wiped out. And seeing stories like that, seeing my clients be successful, becoming, friends of my clients in a lot of ways. I mean, because we're just, we're family oriented. And Garry, watching my team grow. I mean, I've got people that have been with me for 14 years. All right.
Awesome.
One of my top guys last year, he had the biggest year financially he's ever had. He's had a baby now, bought a new home, right? My number 2 guy, bought his second home first, beautiful child. My staff, they love coming to work and they love what they do, and everybody's growing. The company's growing, they're growing, the client base is growing. And I guess it's just serving others. And I don't know how it happened, but when I stopped focusing on me and started focusing on serving others, everything in my world changed, and I just felt a strong passion for it. So if I can get up today, play a little golf, all right, and then go help some people, I'm all in.
Well, I appreciate you motivating me, but because that's really my focus right now is getting myself where my team is just on all points. I want to take care of them, because if we're taking care of them, then they're happy and they're going to take care of us, as the CEO of these outfits, which is really, really neat. 2 more questions for you. Then I'm going to get a little more personal into you. What's a financial topic that you wish people understood a little bit better? I mean, money's money. It's an emotional thought process. It's hard, but what's a topic out there that you wish people understood better, but they often don't?
I would say it's be open-minded.
I like that.
Yeah, be open-minded, because there's opportunities out there in the investment space that can really change the outcome of what you're trying to accomplish.
Yeah.
And we do a lot of educational events at Allied Wealth. Part of the reason we do that is this: if you go talk to family members about money, oftentimes it's taboo to talk about money. All right. My dad will not discuss finances with anybody. All right. Never, ever. Occasionally he'll kind of give me, hey, son, I'm here now, and this is what I got going on. And and I'm like, okay, cool. But he just won't talk about it. To him, it's taboo to talk about your money. It's just where, it's where he's from Cherry Hill, New Jersey, the Jewish community up there. And it's just, you don't do it. Right.
Right.
And then that's common across a lot of families. Okay. Then you go to work. All right. And you talk to, or friends group, kind of the same thing. Some people will talk about it. Some people won't. Bob at the water cooler is trading hurdles and leaps and iron condors on company stock and that sort of thing, and tells you to do that. And then, some family members like, I'm buying direct investments in oil and gas. Well, that family member may have 10 times the money you do, could lose half his money twice and still be rich, right? You don't know. Then, to make it even worse, you go talk to 5 different financial advisors, and you're likely going to get 5 different opinions,
100%,
about what's out there. And then to make matters even worse, you go talk to those financial advisors. You go on and you go to the world's greatest financial advisor. That is Google. Okay, and this guy says do it this way. This guy says don't dare buy that. Put all your money here. Index, active invest, tactical invest. Don't buy annuities. Buy annuities. It's just so much stuff out there, and it's a very hard thing to navigate.
Right.
And what's become a do-it-yourself world, because the onus of a successful retirement has been put on your shoulders. Okay. And so to me, it is to understand and be open-minded about what's out there. Don't just pigeonhole something and say, I heard that we'll use the annuity again. I've heard an annuity's bad. Okay. Well, it might be. If you've got, a pension of $150,000 a year paid you by Exxon, well, Exxon ain't going anywhere. Okay. Yeah. And if your income's $100,000, your income demands $100,000 a year, and you've got $150,000 a year in income, you don't need an annuity. No. Okay. It's that simple. But if you don't have a pension, you need $100,000 a year income. You've got $40,000 coming in from Social Security. Okay. That's a $60,000 a year income gap. All right. Well, the way you can solve that is you can buy an annuity. And guess what? The biggest threat you have is outliving your money. You will never outlive the payments from an annuity. Your spouse won't either, right? So it's just, I think, be open-minded, be willing to listen, be willing to understand.
I think that's vital. And again, to follow up on that, that's why I think people need to really focus on working with independent advisors like you and myself that have the world to shop from. I use an analogy all the time. Do you want to go to the grocery store and have 3 aisles to shop from, or go to the grocery store and have the whole store to shop from? Because some of these big box stores, as you referenced, they have 2 or 3 aisles where you and I have the whole store. And I just think that's important for people to know. Working with a fiduciary independent advisor firm, you're going to be better off. Bottom line, at least get a second opinion from someone to make sure you're on track. I got 2 questions for you personally, Ryan, and I love these 2 right here. If you were not a financial advisor, if you were not running Allied Wealth, what would Ryan be doing?
Flying jets.
That's what I thought. I actually wrote it down. I went flying.
Yeah, flying jets. Being a great dad to my kids and being a great husband to my wife and flying jets. That's what I'd be doing.
You just said your father graduated from Top Gun, so your father was your inspiration to get into aviation.
My father is a large part of the man I am today, but in a big way.
That's awesome. I love that. So great. And this is a good one, and maybe it was your father. I'm not sure. What's the best piece of financial advice you ever got, and from whom?
Oh, wow. The best piece of financial advice I ever got. I might think about that one for a minute.
That's a good one, isn't it?
Yeah, it really is. I think the best one is it's a little bit industry specific. Advisors are always looking for growth, and it was not chasing shiny objects. Okay, because Garry and I do TV shows, we do radio shows, we do seminars, we do workshops, we do classes, all this stuff we do to market our company, digital marketing. And what begins to happen is you could overspend And so to me, it's not what you make, it's not your revenue, it's what you keep in the bank after taxes.
Yeah.
That's what it comes down to. So focus on, more about what you keep than what you spend.
I love that. It's not, is it our friend Joe Wilson always says it's not about what you have, it's what you get to keep. I love that. So Ryan, tell the great folks now, again, I'm going to go, you're in Texas, Arkansas, Louisiana, New Mexico, Oklahoma, got 22 offices all over the place there in the South. How can folks reach out to you and your group? How can they go watch your TV show, listen to your radio show, listen to the On the Target radio and TV show that you have?
Yeah, so the show is actually just been rebranded. So we've launched. We were on the money for a number of years, but we started surveying our audience and our existing clients, and we rebranded the show as Redefine Retirement.
Okay.
And it's personal finance to retirement. And the reason why we did that is we want to reach a larger audience because the major wealth transfer that's going to go from husband to wife and then wife to children, and there's a lot of need there. All right. And then as far as getting a hold of us, our website's allywealth.com. Super easy to get a hold of. And then the radio shows and TV shows, they're all over Houston. There's a listing of them on our website, and also in the Austin markets as well. So plenty of ways to get a hold of us, but the best way is to just go to allywealth.com. All kind of great information on the site about us.
And you have some of your video work, TV shows, radio shows on your website as well, correct?
Sure. And then we've got our YouTube channel is Redefine Retirement. I think we're up to 230 videos on there, and rapidly climbing. And then we have our podcast as well that airs on the YouTube channel as well.
I love it, Ryan. And let's talk about really quick something that we're very proud of here is our plantodaytaxbill.com. You and I started this show talking about future taxes, and you have one, retirementtaxbill.com. Is that correct?
It's actually onthemoneytaxplan.com.
Onthemoneytaxbill.com.
And listen, it doesn't matter if you go to Gary's side or my side. It's the same thing, folks. This is what's interesting. We make this offer on a radio show all the time. Yeah, and I call it the tax bill challenge. And people are like, they go to the site and they put in some basic information and they look at what the tax bill is going to be. And I say, okay, compare that to your health care. Yeah. And what's really interesting is they're both unknowns.
Yeah.
Okay. You typically can control to an extent your health care, right? If you work out, take care of yourself, eat right, but things happen. I mean, we can't control as much as we can control taxation. I can help you control that in a big way. Okay. So if the majority of your money's in an IRA, and 20 cents of that dollar that you take out of your IRA to live goes to Uncle Sam, okay? If I can cut that 20 cents down to 10 cents, does your money last longer?
Yeah.
Does the fear of outliving your money kind of subside a little bit?
Sure does.
Sure it does. Do you have more money in your pocket to fight healthcare expenses? Sure it does. That's what that tax bill is all about.
And so on the money tax bill, plan today tax bill, you're right. They're exactly the same. What I love about both of these, you do it from the comfort of your home. There's no intimidation there. We're not asking for appointments. Just go and look at it and study it against what we think future tax numbers might be. And it might inspire you to call Ryan's office, call my office, come in and sit down with a fiduciary advisor, and let's talk about some Roth conversions while taxes are on sale.
Well, Garry,
there's one more thing. Go ahead, Ryan.
There's more than Roth conversions, man. All right. Remember this. So you could have up to about $90,000 in income today in capital gain income, and then another $30,000 in IRA distributions. That's about $120,000 of income and pay zero taxes. All right. So, yeah. And so there's that aspect. There's Roth conversions. There's also tax gain harvesting. I see people come in my office and go, hey, man, my advisor, I got this windfall back on March 9th, 2009 at the absolute low of the market, and we bought into the market. And now I've got this massive gain. Are I doing great? I'm like, no, you're not doing great. Sell it. And they go, well, what do you mean sell it? Why would I do that? I got to pay the tax. I said, exactly. Okay. So you need to understand the concept of tax gain harvesting to where as that position's going up in value, sell it, realize some capital gains. You can buy it back right the next day. There's no tax loss harvesting issues there. You're tax gain harvesting. So, Garry, it goes beyond Roth conversions. There's so much of tax planning that we can do. But the bottom line is that tax bill calculator is designed to show you what your threat is. And Garry and I can get to work on mitigating that threat if you allow us to do so.
I love the way you say that. Another thing you do is find Ryan and Allied Wealth on Instagram, Facebook, all the podcasts, YouTube, X, all the different things. Ryan is out there. His advisors are out there. They're giving great advice, and it's all educational videos. I would encourage you guys to go to the website, alliedwealth.com. Check out that radio show. Check out those TV shows. Get to know Ryan and his team a little bit better. Again, if you are in Texas, Arkansas, Louisiana, New Mexico, Oklahoma, they are there for you. If you're good here in the good old state of Tennessee, Georgia, Alabama, we're here to work with you at Guardian Investment Advisors as well. Ryan, I cannot thank you enough for being on the podcast with me. I hope you had a good time.
My pleasure, brother. Always good time with you, bud.
All right, take care. God bless. And folks, we will see you on the next edition of Money Across America.